This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The AI bubble talk has grown to a stadium-filled cacophony, but potential outcomes are far less clear than the headlines would have you believe. Up next, speculation and overconfidence are up, but history suggests an imminent crash is not, in fact, a metaphysical certainty. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. I was just looking at some data on FactSet this morning, actually. Pretty stunning. Guess what the market returns look like as of April 8th's close, just a few months ago. As of April 8th, the S&P was down 15% for the year. Nasdaq 100, almost 19%. Russell 2000, the primary small cap index, almost 21% for the year as of that date. It's amazing how far we have come in such a short period of time. It's been a rally for the ages. You know what I'm going to say. Be careful overreacting, I should say, to short-term market movements. And we have clients that did, unfortunately. Yes, it was very much a minority, just a handful, but there were people we have that wanted to sell everything, literally sell everything in April. Think about what that may have meant for your retirement had you done that. And, the lesson is, predicting what will happen while you're in the middle of a downturn is oftentimes just as hard as figuring out when the downturn is going to occur in the first place. I mean, when stocks are falling, it always feels like it's too late to sell, right? But still too early to buy. People get caught in the headlights. And the lesson is, if you're committing money to the market, even though the history says you're better off just kind of throwing it in there, I like the idea of dollar cost averaging, sticking to an investment plan, particularly our younger clients who are just building up a portfolio. Invest on a monthly basis with your paycheck, regardless of what the headlines and the markets are doing. For the rest of us who are a little bit further along, maybe already in retirement, you've got to know what you own. And when I say what you own, you don't necessarily need to know the fundamentals of every single stock that you have in your portfolio, but you need to know where your concentrations are, right? I've talked about this a lot, how the S&P 500 is not a diversified index anymore. Its performance is driven by literally a handful of names. You need to know that. You need to know how much is in small caps, how much is in international, how much is in fixed income. And you need to know what your cash needs are. When do you need the money from your portfolio? What is your withdrawal rate going to be? All right, I'll leave it at that, but I just thought I'd comment because the difference in returns today versus just a few months ago are pretty darn stark. As far as where we are today, well, the precedent is still suggestive of a reasonable close to the year. Now, obviously, I'm not in the forecasting business, but I was looking at some data from Strategas. We are in the top 25 S&P 500 performances from January through the end of October, going back to 1945. We're in the top 25. And guess what the history suggests? The other 24 best returns, January 1 through the end of October, the November and December performance was up an average of almost 5%. And get this, only one out of those 24 times was there a negative performance in November and December. 1 out of 24, and that was 1986, and it was only a loss of 0.7%. So obviously, the past is no guarantee of future performance. We all know that, but the precedent is for seasonal rally here or continued rally over the next couple of months, even if things have been a little squirrely the past couple of weeks with the shutdown, the bar pretty high for earnings, which I'll get to in a second. The other thing I just thought I'd note quickly, this is a little bit of a sidebar, but how many times have I said over the past 20 years, literally 20 years, do not let your political leanings or your handicapping of political outcomes inform your investment positioning, okay? It is a recipe for portfolio disaster or at the very least, portfolio underperformance. So I saw a really good piece from Morningstar talking about some of what has transpired in the last year or so versus the immediate reaction from the markets right after Trump was elected last November. Okay? In other words, pretty much, I would say almost everything that happened initially has eventually corrected and gone the other way. To wit, right off the bat, U.S. stocks rallied while European stocks got killed last November, December on the fears that Trump's tariffs would hurt its export-dependent companies. Well, that has completely reversed. Now, of course, the U.S. has still done well, but European stocks have actually outperformed the U.S. for the first time in well over a decade. It's gone the other way. In fact, people have gone so far as to say that Trump has actually helped Europe more than he has helped the U.S. Now, I'm not going to go that far, but that's what the market is saying. Second thing, investors bet on what else? Tax cuts, deregulation, a protectionism bid that would, bid up U.S. small cap stocks and maybe help sectors like financials and energy. Well, that hasn't happened either. Yes, small cap stocks have done better the last couple months, but they still underperformed large cap stocks by a wide margin. Trump's policies have not helped the U.S. small cap stock market. And energy sector, it's one of the three worst performing sectors year to date. And financials have done okay, but still their performance year to date is roughly half that of the S&P 500. So betting on those sectors has not really worked out in any significant way. How about the dollar? Right after the election, the U.S. dollar surged. Well, dollar has been extraordinarily weak the last 6 months. So whether it's the impact of tariffs or concerns about the government debt, for whatever reason, the dollar has weakened against the euro, the pound, other currencies. And the last one I'll just mention briefly is initially, right after the election, Treasury yields jumped. Right? Nervous bond investors were anticipating higher deficits, maybe more inflation. That has also gone the other way. In fact, just in the last few months, bond yields at one point in October dipped under 4%. They're a little higher today. I'm talking about the 10-year Treasury. So I won't belabor the point. Those are four major market moves that started out in one direction and have gone in a completely different direction in the ensuing months. And this is not unusual. I mean, just look at the last 25 years. George W. Bush, he was seen as a business-friendly president, presided over massive tax cuts. Under his tenure, 7-year tenure, the U.S. stock market had an average annual return of negative 2.3%. Again, this is from Morningstar. How about Obama? He was perceived to be one of the least friendly presidents to business in U.S. history. The stock market averaged 15% under his tenure. Even more recently, right? The Biden administration very publicly tried to promote renewable energy. Well, guess what was the best performing sector during his presidency? Fossil fuels. Okay, so you get what I'm saying. What you think might happen politically, often something completely different happens in the real world. And so if you position your portfolio anticipating a certain outcome, or like I said earlier, that is really infused by your political biases, you're probably making a mistake. I thought about this the last couple of days because we had some elections, as you well know. Here in Virginia, we elected a new governor. This is why this kind of sprung to mind. But it will also spring to mind again as we get closer to the midterm elections next year. So this will not be the last time that I mention this. But, the title of my show this week is Only AI Can Break Your Heart, which, of course, is a play on one of my favorite Neil Young songs. But AI has been all the talk, right? And what has also been all the talk has been an emerging bubble. And the term bubble has been thrown around, I think, kind of indiscriminately in many ways. Bubbles are very difficult to define. You can't just go through a checklist, right? Because it's a combination of valuations, expectations, emotions. So there's there's maybe a quantitative aspect to it, but very much a qualitative aspect to it as well. So I'm not here saying that we're in a bubble or we're not in a bubble with respect to sort of the AI narrative. But I will tell you a few things. If you look at some precedent, let's look at sort of the negative side of a bubble, right? And that of course, was the unbelievable dot-com bubble, right, in the 1990s that eventually culminated with a pretty spectacular meltdown starting in the spring of 2000. If you compare that to the roaring 20s, Japan in the 1980s. Those three are all pretty close. But importantly, the Nasdaq 100 run in the last 10 years, which is very much driven by tech, the numbers are pretty darn close. So this recent decade has been very similar in magnitude, again, to the Japan bubble in the 80s, dot-com bubble, Dow in the 1920s. We're right there. So the obvious question is, are we set up for that again? What are we set up for? The crash. Well, understand the numbers. Following the bursting of the dot-com bubble back in 2000, like I said, spring of 2000, the Nasdaq crashed more than 80%. Dow did not go down that far. S&P didn't go down that far, but the Nasdaq crashed 80%. From 2000 through 2008, 9 years, Nasdaq 100 was down 50% in total, about 8% a year. If you go out further, 2000 through 2013, total return for the Nasdaq 100 was 1%. Not 1% a year, 1% total over 13 years. And by the way, these numbers are from Ritzold Asset Management. That was a lost decade and then some. So that's kind of the worst case scenario here. Now, as I've talked about a lot in the past few months, I think there's a lot of differences from the tech leaders today and the tech leaders in 2000. So I'm not drawing that direct connection. But the magnitude of the run has been very similar. So you have to be prepared for the idea that the magnitude of the fall could be similar. But just to play devil's advocate, it doesn't have to end with a crash. Again, this is from Ritzold Asset Management. They did a good piece on this just over the course of the last week. You had obviously spectacular crashes in the 30s associated with the Great Depression. You've had some spectacular crashes, of course, in the 80s and late 90s, early 2000s, and of course 2008. But there was a pretty big gap in the middle, between 1930s and 1980s, where you didn't have any big crashes. And if you look at the 1950s bull market, for example, that's a period that no one ever talks about. And that's the period sort of coming out of World War II. Of course, you had the baby boomers and the rebuilding of, as GIs returned from the war, right? No one ever talks about that market, but it was pretty darn spectacular. I mean, the annual returns in 1954 and 58 are two of the best years in stock market history. 7 out of those 10 years were up double digits. The biggest drawdown year was only minus 11%. So that decade, best decade ever in U.S. history, up 19.5% a year. Total return of almost 500%. The reason I bring this up is there was never a big crash at the end. I mean, the 1960s weren't great, but they weren't terrible. I think the S&P averaged just shy of 8%, so a little bit below the historical average of closer to 10%, but nothing awful. And again, if you look at the corrections along the way, there are several 20% plus declines in the 1950s, but they weren't very long in duration. Okay? So the point is, it is not a metaphysical certainty that what's going on in AI has to end really badly. It's not. History does not suggest that. I am not in the forecasting business or the predicting business, but just know the inevitable outcome here is what goes up, this idea that what goes up has to come down. That is not a foregone conclusion. It goes back to what I was saying at the top. What it does mean is be aware of what you own. Be aware of your exposures. What percentage do you have in AI? What percentage of your portfolio do you have in tech? Lord knows we have weightings in both in our client portfolios, but we're very cognizant of that. We're also cognizant about balancing around that, offsetting some of that risk, knowing what the correlations are between certain sectors and stocks. That's very important. By the way, you might ask, and I've talked about this before over the years, but I'll talk about it again. You might ask, what does precedent say about buying, at all-time highs? The market has hit 36 all-time highs this year, one within the last few weeks. Well, according to Nick Majuli, who did a lot of statistical work on this, he went all the way back to 1915 and looked at the Dow through the end of October. So this is a pretty comprehensive, more than, 110-year, roughly, performance. And he looked at if you bought at an all-time market high, what would be the probability? Well, first he looked at any day. Let me back up a second. He looked at any day over the last 110 years and asked what would be the probability that at some point in the future the market would be lower. It's about 96.7%. He ran the same analysis if you bought at an all-time high. The odds of the market being lower in the future was only 97%. Essentially no difference. So there was no statistical difference in his work between buying at an all-time high or not. Same thing goes if you look at forward returns. If you look at future one-year returns over that same period of time, when buying at an all-time high versus not, the one-year returns show that you were slightly better not buying at an all-time high. It was about 10% versus 8.3% return. But if you go out to 3 years, your returns were actually better. Actually better on 3-year returns if you bought at an all-time high versus not buying at an all-time high. So what's the takeaway? The takeaway is there is no meaningful correlation, really, between buying at an all-time high or not buying at an all-time high. And again, if you have a 3-year time horizon, you're actually better off. So again, the only reason I say all this, I'm not encouraging you to go out and to deploy all your cash tomorrow. I'm just making the point that anybody who says in a headline or media, you got to get out because the markets are at an all-time high, there's just no historical suggestion that that is a reasonable investment approach. There's just not. Can't find any data to support that. So I'll leave the further conclusion up to you as to sort of what you should do at this point, but doesn't mean you shouldn't be doing it. Let's put it that way. Same thing from a valuation perspective. I've talked about this before that, extended multiples, extended valuations really don't have any relationship to or any bearing on future return, 1-year or 2-year returns in the S&P. All you need to do, and this is according to FactSet, if you go back to 2020, that was kind of the last time that stocks were this expensive. We were at almost 24 times earnings coming out of the pandemic. A lot of people thought the market was super pricey. Guess what? Market's doubled over the past 5 years. Doubled. You know why? Because earnings have doubled too. Earnings have doubled as well, bolstered by almost record high profit margins. So you can't just look at valuations in isolation. You've got to consider earnings as well. So price to earnings multiples, they can compress from falling prices, but they can also compress from rising earnings. Keep that in mind, folks. But I will say, there has been a rise in speculation, and what you've seen over the course of the last couple weeks, you've seen a pickup in market volatility. You've seen the market pull back a little bit, particularly in the most speculative areas of the market. You've seen Bitcoin pull back. You've seen a lot of the real kind of aggressive high multiple stocks like Palantir, for example, trading over 100 times earnings. That stock has pulled back despite, a pretty good quarter by all reports. And in general, you're seeing a rise in speculative activity. For example, SPAC IPOs, which stands for Special Purpose Acquisition Company. Those are essentially IPOs that are a blank check. You're buying a manager who hasn't made any investments on the promise that he's going to make good investments. Those are on the rise. Meme stocks are on the rise. What's also on the rise, and I talked about this last time a couple weeks ago, leveraged ETFs are on the rise. You can buy ETFs now, exchange-traded funds, that are 4 or 5 times leveraged to the performance of a single stock. Talk about speculation. So when you see all these things in aggregate, I'll give you one more example. 0-day options. I've seen a rise in the trading of those. Those are options that expire in less than 24 hours. That means you're essentially gambling on short-term price movements, ultra short-term price movements. So I'm of the opinion I would like to see a lot of it get flushed out, a lot of that excess get flushed out. I'm not saying I want a 15 or 20% pullback, but I would love for the more speculative areas of the market to really come back down to earth. And you've started to see some of that the past few weeks. We know that the bar is very high, right? course, as I mentioned, we're getting the third quarter reports. A lot of companies have come out with really good numbers, beat on the bottom line, beat on the top line, raised guidance going forward. Stock prices are still down 5, 10, 15%. Because the stock rallied coming into this, that expectation was already in the price. There was nowhere for the stock to go. And there have been some exceptions to that. Some stocks have rallied after the earnings reports, but in a lot of cases, the bar was essentially too high. So a little bit of a breather here is not a bad thing, in my opinion. The other thing, just to be cognizant of, we have seen some narrowing in the breadth of the market. Of course, it's been an overarching theme the past few years that a lot of the performance has come from a handful of names, mostly large tech stocks. But just in the past few weeks, that's increased even more. And a lot of that's backed up by earnings. So yes, earnings have been better than people expected. But according to FactSet, the earnings for the Magnificent Seven are up roughly in aggregate about 19% year over year. And NVIDIA hasn't reported yet, so that's the other 6. 19% year over year. You back them out, the rest of the S&P about 3% year over year. So some of this is is kind of backed up by fundamentals. The earnings growth has been concentrated. It's not just stock price performance. The earnings themselves, the fundamentals themselves have been concentrated in a handful of names. And some people have pointed to the dot-com bubble, but I will tell you that's misguided in my opinion. Back in that period, and I remember this because I lived through it. I was managing money through it. The kind of the equal weighted S&P peaked out in the third quarter of 1999. A good, 6 to 9 months before the market eventually popped, or the bubble eventually popped. That's when the rest of the market started going down and only a handful of stocks were still going up. That's not the case today. The equal weighted S&P, which gives equal weighting to all 500 companies, was hit an all-time high as recently as within the last 30 days. So don't let anyone tell you that, this is exactly like the dot-com bubble. It's really not from that perspective, but it is something that we will watch going forward. The other thing that made the rounds this week is a couple big CEOs at Goldman Sachs and Morgan Stanley. They were at a conference talking about the possibility of a correction. I'll give you the exact quote from Mr. Solomon over at Goldman Sachs. He says it's likely there will be a 10 to 20% drawdown in equity markets sometime within the next 12 to 24 months, end quote. That's from Bloomberg. Well, that's not even news as far as I'm concerned. There are always that type of odds for a 10 to 20% correction over the next 12 to 24 months. We've averaged a 10% pullback roughly every year for the last 100 years. That's not news. About 20% pullback every 3 years. Well, we got a 20% pullback just in April. So the odds of one over the next 2 or 3 years, probably pretty high. So what was positioned as market-moving news, hardly news at all. They're just talking about the average pattern of the markets going back 100 years. But as I mentioned, getting some of that speculative froth out, I would be supportive of that. I would love to see that. Just a few other things that I wanted to mention. I don't want to talk too much about the macro environment, but it has been incredibly newsworthy 2 or 3 weeks here. There is a lot going on at the macro level. We know that, the Supreme Court is currently deliberating about the legality of Trump's sort of tariff platform. By the time you hear this, I'm doing this on a Friday. By the time you hear this on Saturday or Sunday or next week, maybe they've already come out with their decision. But so I apologize if I'm sound out of date. But as of the end of this week, I think the market is of the opinion that a lot of these tariffs will be reversed. But I will tell you, the market impact from that may not be what you think. And from I know the tariffs originally back in April weren't all that popular, but I think the market assumed that even if they were going to get thrown out, that President Trump has many other levers that he can pull, okay? And according to Strategas, they came out this week and said, in their opinion, roughly 2/3 of U.S. trade will not be impacted by the Supreme Court decision. And that's because, like I said, Trump can immediately turn around and use other authorizations to justify tariffs. So maybe there are some refunds given, but those will be reinstated, I think, pretty quickly. The other thing is, there's concern that if the tariff revenue does decline, or if it's reversed in some way, that could be bad for U.S. debt, right? Because presumably some of that tariff revenue has been used to offset spending or reduce the debt. I don't know if that's actually the case, but I think that's been a bit of a market concern as well. But net, I think consensus is coming to the view that the overall tariff rate will probably be closer to 10% than the 20% that was originally feared in April. So I'm not minimizing the impact of tariffs, but I think there's a reason, one of the reasons why the market has rallied over the past 5 or 6 months is I think a lot of the big money, the smart money out there is understanding that the tariff environment is not going to be as severe as what was originally anticipated, back in the spring. And maybe policymakers are starting to come around to that as well. I think originally the tariffs were considered to be inflationary, and that still will probably be the case, at least on a temporary basis. But ultimately, it's deflationary. It leads to slower economic growth. And again, I think the Fed just seems to be waking up to that. In terms of what else is going on, obviously we have a government shutdown that is now at a historically long duration. So far, the market has not overly responded to that. I think the news this week of airlines canceling a bunch of flights, that could be the trigger to really get both sides to come to the table, because that is going to be a real negative pushback on the economy. We haven't seen the market react too much, but certainly within the market, consumer discretionary stocks, a lot of them have been trading in line with the halting of SNAP payments. So we are seeing some sensitivity to the shutdown, but not in a massive sense. The other big news, of course, was Trump's meeting with China leadership. And I think really the main takeaway there is there was no escalation. There was no escalation. So even if this thing needs to get renegotiated, even if there are going to be fits and starts along the way, the fact that there was no increasing tension from those talks, the market seems to have responded well to that. The last thing I'll just mention is what the Fed's doing. Of course, they cut rates the other day. What has gotten less press is that they are effectively ending quantitative tightening, tightening the balance sheet by the end of December, which really is another quarter point rate cut if you look at sort of the impact of that. So, you add it all up, whether it's negotiations with China, what the Fed's doing, the shutdown, Supreme Court review of the tariff legality. You add it all up, I would say net, it's been much more positive for the market than not over the course of the last few weeks from a macro perspective. So don't get overly plussed about the headlines. Yes, they'll feed volatility, but I don't see any major negative developments in the past few weeks. Again, from a market perspective, you might feel differently as a citizen, but you've got to separate out your citizen cap sometimes from your investment cap. All right, I'll leave it there. I have a few minutes left. I do want to touch on a few earnings reports. Stick with me. Back in a sec. The unwieldy fire hose of daily news flow is only getting stronger. How do investors separate the noise from what actually matters? Tune in every week as we discuss the latest financial trends and how to filter what's distracting you from investing success. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. We're about 3/4 of the way through third quarter earnings reporting season. As I mentioned, it's been a better quarter than anticipated. Earnings growth overall, almost 4 percentage points better so far than what was anticipated as recently as 2 months ago, according to FactSet. But it has been top heavy. A lot of that has come from the Mag 7, some of the mega cap tech stocks. But I just want to highlight a few reports that kind of stood out for me. Remember, when I talk about individual names, the names I'm going to mention this morning are names that I own personally and that we own in a number of our client portfolios. You can consider that a conflict of interest. The other thing is, if you are a client, I think you can feel comfortable that we've done our due diligence and feel that these are appropriate investment vehicles for you. If you're not a client, please remember you need to do your own homework to make sure they're appropriate for your particular situation. But one report that stood out for me was Uber. Uber is a relatively new name to the portfolio, started accumulating it for clients earlier this year. I think you all know the ticker symbol because it's also Uber, UBER. You know, Uber, the stock price reaction has actually been negative. I think the stock's down almost 8 or 9% since their report. But if you look at it, the stock, they kind of remind me of Amazon a number of years ago. If you recall, Amazon was spending a lot of money to build out their network, to take market share, to increase their systems and technology infrastructure. That cost them a lot of money, and in doing so, they kind of sacrificed some margin. So they were actually less profitable than they could have been because they were just trying to grow the top line. And that's kind of where Uber is. Uber had over-delivered in many ways if you look at their quarter. And there's a really good report from Evercore on this. You know, the Evercore analysts noted that they accelerated their bookings. That was the fastest growth in 4 years. Revenue growth significantly beat. That was on the delivery side, like Uber Eats. And really, same thing on the mobility side. Also record bookings, revenue growth accelerating. It's just that the margin expansion there wasn't as much, and I think that's why the stock was down. But a lot of that has to do with the spending that they're doing, particularly expanding their network in rural areas, less penetrated areas, also some of what they're doing overseas. The bottom line is, though, the numbers for a company of Uber's size are really quite remarkable. I mean, overall, rideshare and online delivery is growing at 20% plus, in terms of bookings. Very strong free cash flow generation. That's over a 20% ramp in free cash flow. They're putting up numbers that, quite frankly, almost no companies in the S&P, maybe only a handful, are doing at that scale. Meanwhile, the stock's trading at about 16 times enterprise value relative to EBITDA, which is kind of the way that people value Uber, which is a pretty sharp discount to their growth rate. So this is what the Evercore analyst is saying. And what the analyst was also noting was what they're doing on the autonomous vehicle side. I mean, they've made the decision to partner with a number of different makers. So they're doing stuff with Waymo, Google's Waymo. They're doing deals with Tesla. They're dealing with a number of different companies. So they're almost channel agnostic from that perspective. But what they are doing is creating a sort of an essential technological infrastructure to support those businesses, which companies are paying up for. So I think they're taking the right approach. It's just expensive. So if you can live with profit margins that aren't ramping ad infinitum over the next few years, and the trend there on the top line is still this good, I think it's an interesting story. So again, the risk factor would be just that. Are they cannibalizing profitability to an extent that makes it not as attractive from an earnings growth perspective? That's the risk factor. But net, I think the price reaction to their earnings report was probably a bit overdone. By the way, just a side note, people talk about, hey, is autonomous driving, is that really a thing? Is that just a fad? Well, Waymo, which of course is owned by Google, Waymo is now doing 876,000 rides per month in California. That's a six-fold increase over the past year. 69-fold increase since August of 23. That's according to Charlie Bolello. Again, that's just in California, but as they expand their markets, if they have anywhere near that type of explosive growth, it's going to be something. Another one I just wanted to mention is ABBV, the drug company. I've talked about ABBV numerous times over the years. Their flagship drug, Humira, rheumatoid arthritis drug, went off patent a few years ago. That was at one point almost 80% of their sales. And so ever since that time, they have been rebuilding their pipeline, diversifying around Humira. If you look at their most recent quarterly results, the Humira erosion actually increased. However, ABBV not only beat on the bottom line, they beat on the top line and raised their guidance going forward for the third time this year. Okay, that's according to FactSet. The Raymond James analyst noted that even with a number of headwinds, greater than expected Humira erosion, potential negotiations with Medicare that could cap some of their drug prices, even with all that going on. And by the way, remember they bought the parent company of Botox. That business has been depressed. Even with all that, AbbVie actually raised their guidance and reiterated their confidence in high single-digit growth, revenue growth, through the end of the decade. They feel there's really good visibility going out another 4 or 5 years. And that's because of the strength of their immunology, their neuro franchises. They have a fledgling Parkinson's franchise that is really starting to get traction. So the AbbVie story, I think, is pretty darn impressive given the challenge they had of not only recreating those Humira sales, but accelerating their overall growth going forward. The risk factor, I would say, with AbbVie is probably the regulatory environment. It's just been a very volatile environment with Kennedy Jr. and Trump, tariff uncertainty. Some of that, I think, is behind us already in terms of some of the news flow that's come out the last few months, but that is still very much an issue over the course of the next few years. It will be interesting to see what happens if the Democrats do win back some seats in the midterm elections. Presumably, that could be somewhat actually favorable for the drug industry, with the emphasis on extending Obamacare. So we'll see. So there are some risk factors there, but the story in the meantime, very impressive. I just want to mention Amazon as well briefly. The reason I bring up Amazon's results is, their real sort of profit driver, of course, has been AWS, right? Amazon Web Services. And Amazon stock has not done particularly well the last 18 months, not only on an absolute basis, but also relative to the other big tech names. You can trace that pretty clearly to a deceleration in Amazon Web Service revenue growth. They went from 25% plus to mid to high teens. Well, what stood out for me about this recent quarter with Amazon is a re-acceleration in that growth, material acceleration. Okay, so back to 20% year over year. So if Amazon can keep that up, I was reading a couple reports from Deutsche Bank, Evercore, they were saying the same thing. There's the ability for Amazon stock and the valuation that people are assigning to Amazon stock to re-rate higher. Okay, so again, up until a month ago, Amazon was only up a couple percent a year. Actually, at one point they were negative for the year, but I think they were up a couple percent for the year as of like mid-October. So this could be the catalyst for them to really find their footing. The risk factors are pretty clear. It's a very competitive business. They're competing with Microsoft's cloud storage product, Google's product. So there's a lot of competition there. And of course, a lot of it's contingent on IT spending and AI-related spending. And then, of course, there's the other side of Amazon's business, the health of the American consumer, right, which has been depressed here in the last few weeks and maybe into the end of the year. And everyone's kind of hoping for a reacceleration next year on the heels of a big tax refund season and what have you. But still, there are some risk factors there, but I thought that was worth noting. Last one I'll mention real briefly is Chevron. I don't talk about big energy that much, but Chevron, symbol CVX, Raymond James analyst noted a pretty darn good quarter the other day. Okay, not only their upstream sort of development, production assets, but also downstream on the refining side. And I think the big thing that I noted with their quarter, and the Raymond James analyst noted, was cash flow has really started to build. You're seeing a lot more capital efficiency, much better margins, and they actually increased their long-term annual buyback guidance, the amount of shares they're rebuying. It also seemed to me that their acquisition of Hess Petroleum, which was a big deal, is actually ahead of schedule in terms of cost synergies, cost efficiencies from that. So Chevron's quarter, I think, gave people a lot of confidence that they could be a standout. Remember, they traded a pretty significant valuation discount to the other major integrated energy companies. So I think the risk to Chevron is not really their execution, it's the macro picture. President Trump has been very public about wanting to drive down gas prices, drive down energy prices, so there is some regulatory and political sensitivity to what Chevron's trying to achieve. But if you're going to be in that space, Chevron looks to be an outperformer, potentially at a discounted valuation. So again, I own all of those stocks that I mentioned personally. We own them in a number of client portfolios. Consider that a conflict of interest. Weigh that in your thinking. But I thought those were quarterly reports that stood out for me. All right, that's it for now. I believe Chase Hinderstein will be back with you next week. I will be there on the week thereafter, so I'll get back with you before Thanksgiving. But until then, as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.